Welcome back. You're watching Big Deal and we are discussing the equity market deals while the markets are at record levels. Now, Chirag, we were discussing about the IPOs and there is a strong pipeline, you said. So that's one important takeaway, that there are many more aspirants. But in terms of deal trends, now that the backlog of a lot of private equity, exits as well as sale of shares that has really taken place in the last month and a half, what is the deal trend that is really picking to capitalize on this market window?
So, Nisha, what we've seen so far is really blocks, QIPs starting out. Blocks, quite a few of them have happened.
Yes.
On the IPO side, there have only been 5.
Yes.
So that trend is something that I believe now you'll see a lot more of. Again, I don't believe it'll be like the 2021, where in December alone we alone had done 9 deals.
Yes.
So not frothy times there. Good companies, good valuations will find buyers. There is a lot of interest, and across sectors, whether it's cap goods engineering, whether it's healthcare,
right,
whether it is BFSI,
right,
there are a lot of companies that have got their clearances from SEBI.
Yes.
They're waiting to, to come to market.
Yes.
And I think a lot of them will now find investors that will see value there.
Right.
But I don't think that we're anywhere close to this being a hyper bull market in that sense, or that, there's too much deal activity or any of that.
Yes.
I actually think that the returns that investors have made over the last 3 months, especially in these primary market deals, will bring them into the new deals as well.
All right. So a lot more, and interesting the sectors that you mentioned, and nowhere the tech startup space is getting a place in the IPO pipeline, it looks like. But let's ask Bala. Bala, as an investor, what is the kind of IPOs and what are the factors on which you will base your judgment to invest in an IPO going forward?
I think clearly there are 2 parts. One, the existing well-established business model, particularly the private space, now coming to the market for one going for listing, and also fund the future to the capital raising, as well as even exit to private equity who would have built these businesses in the early part of their things. Now they want to go for the public, therefore buyout divestment. This is all coming from the existing established the balance sheet and business track record, and on the basis of which expected growth that could come on company. Especially it's coming in the EV space, it's coming in the automobile space, it's even coming in the IT product side also.
Yes.
And that's something you can look at it more from the point of view of one, such kind of companies, when it comes to listed space, given the track record, the management and the valuations, and the future the potential of the companies, that's one. Second, as far as the startup companies concerned, there are 2 types of startup. One, of course, the startup, which is more on the service side, which is what we see in the last few years, last few months. We have seen some bit of slowness in terms of IPOs of those kind of companies. But the startup companies more in the manufacturing side. The recent the drone manufacturing companies got some kind of good appeal because the business model is good, something new. Something is actually more the manufacturing sector. Scalable is very, very high. Usage rate can go up quite significantly. That's something unique. I think that's one segment of the market. So we call it as a startup, but the fact of the matter is they are in the thick of the manufacturing space. That's something again we as a fund house pay attention to them. Another factor of the matter is I think the combination of both, and ultimately I think one of the big things that has come in the last 4 or 5 months, post last year November when the IPOs picked out with the new age companies coming into the market, clearly the valuations have become more reasonable, and wherever the valuations are not priced by or set properly, we also see the interest rates levels from mutual funds also low, and that's why I think the market itself get adjusted for the demand supply in terms of setting the valuations right.
That's right, Bala. In fact, kudos to the domestic institutional investors like yourself who did not even buy into the last 2021 frenzy of, the startup IPOs, while the foreign investors had pumped in money. And now it looks like sanity has prevailed on the foreign investors as well. So there are no takers at insane valuations, and those have really come down. That could be a point of worry as well. But Chirag, in terms of sectoral play you have mentioned, but going forward in terms of investor sentiment from the road shows that you're having, Is the foreign inflow continuing to be as robust as we have seen in the recent past?
Absolutely. Just to address, just to touch on some of the points that you made earlier, there was clearly a scenario where there was froth in some of the valuations of the new age companies.
Yes.
A lot of that froth, investors are now acknowledging, has been cleansed. And you're already seeing interest coming back into those spaces. So I wouldn't completely rule out that you will see some new age service company that actually comes to market over the next 6 to 9 months, albeit at much more reasonable valuations. Again, it won't be every company that's trying to come to market. A few good ones with a real service or product at reasonable valuations will see the light of day.
Yeah.
In terms of investor sentiment, very, very clearly, India is the beacon of hope in that sense.
Very few markets are giving the kind of potential, showing the kind of promising potential that India is right
Absolutely.
now. And
I mean, you look at all the macro factors here,
yes,
including on the interest rates. It seems like we're as close to the peak. And that itself is good enough for the investors where, if it's the rate of change that they buy into and that's what moves things for them.
Yeah.
So if the sense is that we're close to the peak or that, the trend from here is either flattish or downwards,
yes,
that's good enough for investors to start looking at markets like India, where we have a 7% growth.
Right.
And other macro factors also aligned for us.
Right. But I would say that even though both of you are sounding extremely bullish because the business is just going so well, right? But Bala, I would say the markets have defied a lot of macroeconomic data, geopolitical aspects, as well as oil prices, which affect India a lot. It has really defied a lot of these factors just because money has been coming in. The inflows have been very strong, stronger than the domestic institutional investors. So my question is, what are we baking in? Do you see a froth? And how do you see the interest rate trajectory as well as the election season being kick-started impacting the markets going forward?
Sure. I think if you look at Nisha on the interest rate front, I think looks like we are more or less the peak of the interest rate hike cycles. Though there is an expectation which got built in the last few days, US probably will go for a final rate hike, and after that they will leave it for some time. So the way I see is the current interest rates will stay for longer, which at least about 6 to 8 months of period this financial year, this calendar year. And probably have to start looking at cutting rates the next year if the inflation comes close to about 2% as far as US target concerns. From India point of view, as we start seeing the narrowing of interest rates somewhat come closer to the previous period, then India probably will start looking cutting rates. But India probably the rates in our belief is will stay for longer. One of the good things that has happened from India is actually the debt equity ratio of Indian companies, of Nifty 50 companies, one of the lowest. And then the borrowing to the debt markets have become relatively cheaper for companies to fund the growth. Therefore, interest rate-led impact on Indian companies for their balance sheet point of view or profit point of view, I think is the least from an negative impact point of view. I think that's coming handy from the equity market to sustain. Second, from the headwind point of view, I think if one looks at more deeply, while sectors, of course, rotation happens in the market, as we have seen the last 1 year, IT companies are not done well for a variety of reasons, whereas automobiles are actually done one of the best in the last 1 year. I think we see these kind of sectoral rotations happening. Our own belief is banking, automobiles, capital goods sectors, including power sector should continue to do well, or transit should continue to do well. At the same time, there is also another macro factor which is driving the commodity prices coming down, especially steel, aluminum, some of the other commodity prices coming down globally. All the input industries will also start seeing the benefit. We are also seeing some benefit getting accrued to the housing material companies. They are seeing some kind of benefit coming in. Cement companies are seeing some kind of benefit coming in with the coal prices coming down. I think the dynamics, of course, keep changing it. I think that's why I think one has to just keep in mind, rather than sticking to one, one has to, of course, keep a very close eye on some bit of sectoral rotation that also will have to be looked at from the money manager's point of view.
Right. All right, Bala. Thanks so much for your insights there. Thanks so much, Chirag, for stepping by and also sharing all your thoughts. And of course, the deal flow is looking strong at this point. And I would just say one thing, that the overall understanding is that the investors are a lot more choosy and a lot more selective at this point, and any paper will not have a calling in the market, and that's a good sign of mature market. With that, it's a wrap on this edition of Big Deal. Thank you so much for tuning in.